Here are 3 S&P 500 dividend stocks that have experienced significant price drops, resulting in historically high yields. While the S&P 500 index currently offers a yield of 1.3%, Realty Income, Franklin Resources, and Hormel Foods stand out with their higher yields of 0.70%, -1.66%, and 0.68%, respectively. Along with their attractive dividend yields, the appeal of these stocks extends beyond just their dividends. Realty Income. Realty Income, a prominent net lease real estate investment trust, boasts an investment-grade balance sheet and a track record of annual dividend increases for 29 consecutive years. With a vast portfolio of over 15,400 assets, it holds the largest market cap among net lease risks. Net leases, which require tenants to cover most property-level expenses, contribute to its stability. Despite its impressive dividend yield nearing a 10-year high at 5.5%, the stock has seen a decline of approximately 30% from its 2020 peak. This drop can be attributed to rising interest rates, which exert pressure on REITs profits. Considering the industry's heavy reliance on debt for asset acquisitions. Historically, property markets have adapted to fluctuations in interest rates, and it's probable that they will do so again in this instance. Moreover, Realty Income's expansive portfolio, which spans both the US and Europe, offers multiple levers for growth. Additionally, the company's size has historically granted it advantaged access to capital, regardless of market circumstances. Essentially, Realty Income is the type of stock that conservative dividend investors could confidently purchase and retain for extended periods. Franklin Resources, an asset manager, concluded the first quarter of 2024 with approximately $1.6 trillion in assets under management. As an asset manager, it earns revenue by overseeing all of that money. While investor inflows and outflows occur regularly, asset management firms typically have pretty sticky customer bases. However, the primary influence on their financial performance comes from market fluctuations. For instance, in the first quarter, assets under management increased by around 16% compared to the end of 2023, primarily driven by stock market gains. Therefore, investors should expect Franklin Resources financials to ebb and flow with market movements. Despite facing challenges such as increased outflows from mutual funds, Franklin Resources has demonstrated resilience by consistently raising its dividend for 44 consecutive years. To offset the impact of these outflows, the company is diversifying into other areas such as exchange-traded funds and alternative investments. But, concerns surrounding its mutual fund division have led to a decline of approximately 35% in the company's stock since late 2021. As a result, the dividend yield has risen to nearly 5.3%. Nevertheless, for investors willing to tolerate some earnings volatility, Franklin Resources has a track record of rewarding shareholders and expanding its business over time. Hormel Foods. Hormel Foods is notable among these selections as a dividend king, having increased its dividend annually for 58 consecutive years. Despite experiencing a stock price decrease of approximately 35% from recent highs in 2022, this decline has resulted in a yield increase to 3.2%. While this yield may not be exceptionally high in absolute terms, it is close to the highest levels in the company's history. Consequently, Wall Street has discounted this dependable consumer staples dividend stock. Hormel faces various challenges including inflation, avian flu, sluggish growth in China, and the acquisition of Planters coinciding with a slowdown in the nut segment of the snacking sector. While these issues collectively appear daunting, each is surmountable when examined individually. Given Hormel's extensive track record of success, it seems reasonable to have confidence in management's ability to navigate these challenges. Moreover, the company's fiscal first quarter earnings results were largely positive, indicating that Hormel is beginning to regain its footing. Investing in the stock now could secure a historically attractive yield from an iconic and generally well-managed consumer staples company for years to come.